So Ross, when you look at overall plan design for investments, what do you typically see these days? What makes sense?
Most plans make use of a multi-tier construct. Historically speaking, or at least in the last several years anyway, most sponsors have talked about a three-tier design that would include a series of target date funds, a series of core options, and potentially a brokerage window.
So in helping plan sponsors set up custom strategies, they're typically going to tap into the core options. What core lineup does the plan sponsor need to be able to achieve optimal strategies?
Plan sponsors really need what has traditionally been a series of core building blocks for a few reasons. And so you can create portfolios with varying degrees of risk using a handful of asset classes, a cash vehicle, a fixed income solution, large cap equity, small cap equity, international equity. And within each of those core building blocks, you have the ability to give managers looser constraints that allow them to add additional diversifiers. In the fixed income space, you can have emerging market debt, global bonds, high yield, TIPS. In international equity, you can have emerging market equity and small cap international equity. And so sponsors really can begin with a more reasonable set of core options. In addition to those, there are asset classes that a sponsor can include with custom strategies that they would not necessarily offer as part of the core. Those would include things like global tactical asset allocation and absolute return strategies.
When you look at defined contribution plans today, what asset classes are typically missing that you would encourage plan sponsors to add, especially as they're designing custom strategies?
Plan sponsors today are really looking at a much broader list of investment opportunities than they have historically. And so they're looking at things like global bond strategies that make use of emerging market debt, global bonds, high yield, TIPS. They're looking at things like global tactical asset allocation strategies. Historically, sponsors have been a little bit reluctant to include some of these strategies and asset classes because participants are not professional investors. And so the conventional wisdom has been offering these options in isolation or as standalone options is potentially risky. On the pension side, sponsors have been more likely to include them because you have a more informed group of trustees or committee members making decisions. On a go-forward basis, particularly in custom constructs of diversified vehicles like custom target date funds, you now have the ability to really include a lot of these diversifiers in a very effective way. You also have the ability to include diversifying asset classes as part of the core options to the extent that you give managers, you take the handcuffs off and you give them more leeway and fewer constraints.
Bottom line, as we look at custom strategies and bringing in alternatives or less liquid securities, what are you seeing?
Well, so a couple things. We've seen several plan sponsors that have gone ahead and made use of liquid strategies. The current environment that we're in, the liquidity crisis of 2008, has certainly made people a little cautious with regard to approaches that make use of liquid securities because when the market is falling, there's greater need for liquidity. And even with some of the traditional vehicles like index funds, for example, that make use of securities lending, when index funds were suddenly illiquid, it made it very difficult for a lot of strategies to be rebalanced and so forth. Having said that, there is a continued evolution on the target date front, and so you will likely see more sponsors making use of direct investment in real estate, for example, and other illiquid approaches. And then in addition to that, you have the evolution of the daily valued products as well. There are, again, using real estate as an example, there are several products out there that are daily valued that make direct investment in real estate. And again, the key there is just that there has to be a liquid portion of the fund to handle the daily flows and the daily valuation. There's nothing inherently wrong with offering assets that are not daily valued. The plan description just has to outline the nature of the assets and how they're valued, how frequently, and so forth.
Kevin, thank you for joining us. When plan sponsors think about capital preservation for their plan, what would you suggest they think about?
Well, a well-structured defined contribution plan should maintain a capital preservation investment alternative. There's largely two alternatives in this space. One is a money market fund, and the second is a stable value option. And we generally prefer a stable value investment alternative to the extent that a fiduciary has regular meetings and can review all the appropriate fiduciary data points on a routine basis. And the key reason for that is because you get 100 to 150 basis points of return premium relative to a money market fund in a stable value alternative with limited amount of credit risk and interest rate risk that can be well managed and thought through at a fiduciary committee level.
And have the considerations around stable value changed since we've seen the insurance companies and wraps and issues in the marketplace?
Yeah, it has changed a little bit, but at the end of the day, the dynamics of a stable value investment alternative remains as compelling as today as it was 24 months ago before we entered into the credit crisis and the deleveraging cycle that we just experienced. There's less capacity for wrap providers, which is a concern. But at the end of the day, we continue to see that fiduciaries with a separate account or commingled vehicles in a stable value environment have come through this cycle very successfully and now are continuing to generate returns that are delivering on the promise of a 1 or 1.5 percentage points over a money market fund.
So do you believe stable value continues to make sense for defined contribution plans?
Yes, absolutely. Stable value remains a very compelling investment alternative. Largely because of the return premium you receive over a money market fund and the fact that the capacity for the wrap providers, while constrained at this moment, remains still available. And at the end of the day, the fixed income credits that underlie the stable value option have come back very strongly. And the crediting rates, the rates of return that participants are receiving are extremely attractive relative to money market funds.
And Kevin, there's been more talk about unwrapping stable value. So it's in essence a fixed income fund. What's your view of unwrapping stable value and offering, for instance, just a short-term bond fund?
Yeah, you can do that as well. The significant downside is the fact that the stability of the principal will not be there to the extent that there's any significant change in the short-term fixed income portfolio from a pricing perspective. The participant will feel that. So if they put $1,000 into an unwrapped stable value fund, they may have $989 at the end of the next quarter to the extent there's an adverse credit event underlying the portfolio. So we would continue to prefer to keep that safety of principal as a key metric for a stable value option. And to the extent that you need to have a diversifying investment alternative relative to stable value and a fiduciary believes that's appropriate, short-term fixed income does have some appeal, especially in the face of rapidly rising rates. It may be a very good place for participants to place short-term capital to avoid capital losses, because we all know when interest rates rise and we can see significant declines in pricing of bond portfolios.
Kevin, let's talk a little bit about custom target strategies.
Oh,
Does it
okay.
make sense to have stable value within a custom strategy?
Yeah, there's some significant merits if you load up a stable value investment alternative into an optimizer. The principal, the safety of principal, and the return patterns that stable value generates is the optimizer likes it because it produces a more efficient portfolio from the perspective that you get this unique accounting privilege of book value accounting that basically flattens out all the significant levels of potential returns that are both negative or positive in a short-term bond portfolio.
So you like adding stable value into custom strategies?
We would find that attractive, yes.